cash. The cash account represents the money a company has on hand, such as bills, coins, or small petty cash funds for daily use. It is the most liquid asset, meaning it is immediately available to cover urgent needs, like paying small suppliers or giving change to customers. Its nature is debit. It increases when money comes in and decreases when money goes out. For example, if a client pays $1,000 in cash for a product, cash is debited. If the company spends $300 from the register to pay a delivery service, cash is credited. An example entry: debit cash, $10,000 for sales and credit sales, $10,000. Because of its constant movements, cash must be carefully monitored. Otherwise, the business risks shortages or internal fraud. A strict control of cash receipts, daily reconciliations, and supervision ensures reliability. In summary, cash is the heartbeat of company liquidity, the most direct reflection of a business's ability to operate immediately. Importance of cash. Liquidity. Cash is the most liquid asset. It enables a business to meet short-term obligations and respond to immediate financial needs. Operational flow. Daily business operations such as paying wages, buying minor supplies, or handling refunds often require ready cash. Decision-making. Cash flow statements help stakeholders assess the financial health and short-term viability of the company. The cash account is the foundation of liquidity management in any business. Its accurate tracking ensures that the company can function smoothly on a day-to-day basis. Poor cash control can lead to operational disruptions, missed payments, or even business failure. 2. Bank accounts. The bank account's asset represents deposits in checking or savings accounts within financial institutions. Today, most businesses rely on banks for payments and receipts, so this account is central to modern accounting. Its nature is debit. It grows when deposits or transfers are received and decreases when checks or bank transfers are issued. For instance, if the company deposits $50,000 from sales, the entry is debit bank. Credit cash. If the company pays $20,000 in rent via transfer, it credits bank and debits rent expense. Proper control is crucial because the account must reconcile monthly with bank statements. This reveals errors, unauthorized charges, or bank fees. A practical case: a supplier is paid $12,000 by bank transfer. The company records debit accounts payable and credit bank. In conclusion, the bank account demonstrates financial discipline and ensures that business resources are protected and traceable. Dame Moss Information and Ingalls. Why the bank account is important. Central hub of transactions. Nearly all financial activity, sales receipts, supplier payments, loan repayments, payroll, etc. flows through the bank. Liquidity management. It provides a real-time view of available funds to meet obligations. Audit trail. Bank transactions are documented externally, providing a verifiable and traceable record for auditing and financial reporting. Security. Funds held in a bank are generally more secure than cash on premises. The bank account is a vital part of a company's financial system. It serves as the primary vehicle for receiving income and making payments, making it central to the flow of business operations. Proper management and regular reconciliation of this account are essential for financial accuracy, operational efficiency, and fraud prevention. A well-maintained bank account reflects discipline, accountability, and transparency in the company's financial practices. 3. Accounts receivable. Customers. Accounts receivable registers money owed by clients for goods or services sold on credit. It is an asset because it represents money that will flow into the business in the future. Its nature is debit. It increases when credit sales are made and decreases when clients pay. For example, a $15,000 sale on 30-day terms is recorded as debit. Accounts receivable and credit. Sales when the customer pays. The entry is debit cash or bank credit accounts receivable. This account requires strict management because uncollected debts can harm liquidity. A small business with $200,000 in unpaid invoices has money on paper, but not in cash. Companies use credit policies, customer checks, and collection teams to reduce risks. In essence, accounts receivable reflects trust extended to clients, but also a potential weakness if not managed carefully. Why accounts receivable matters. Cash flow impact. A company can appear profitable on paper while struggling with cash if receivables are not collected promptly. Working capital. IPAR is a core component of working capital. Delays in collection affect the company's ability to meet short-term obligations. Customer relationships. Extending credit can attract and retain customers but carries risk. Accounts receivable is more than just a record of money owed. It reflects the company's credit strategy, customer trust, and financial discipline. When managed well, it helps boost sales and customer loyalty. But when neglected, it can weaken liquidity and lead to financial stress. Every dollar in a R is a dollar not yet in the bank. So businesses must balance the benefits of credit sales with the risks of delayed or defaulted payments. Inventory. The inventory account represents the goods a company owns with the intention of selling them. For manufacturers, it may also include raw materials and work in process. Its nature is debit, increasing when items are purchased or produced, and decreasing when sold or consumed. For instance, buying $30,000 in merchandise creates a debit to inventory and a credit to accounts payable. Later, when items are sold, inventory decreases and cost of goods sold is debited. A real-world example. A company buys raw materials worth $20,000. Entry is debit inventory, credit suppliers. Inventory management is critical because holding too much creates excess costs, while too little results in lost sales. Companies often use systems like FIFO or LIFO to value inventory correctly. In short, inventory represents the bridge between production or purchasing and sales, and it determines the company's ability to generate profit. Why inventory is important. Revenue generation. It's directly tied to a company's ability to generate sales and income. No inventory equals no sales. Cost control. Managing inventory efficiently helps reduce storage, insurance, and handling costs. Asset valuation. Inventory is often one of the largest assets on the balance sheet, influencing total asset value and financial ratios. Profit calculation. Inventory valuation impacts cost of goods sold (COGS), which in turn affects gross profit. Inventory is the link between purchasing, production, and revenue, playing a vital role in both operations and financial performance. Efficient inventory management supports profitability, liquidity, and customer satisfaction. At the same time, poor handling can lead to unnecessary costs, write-downs, and missed sales opportunities. In essence, inventory reflects the company's ability to meet market demand while controlling internal costs. 5. Notes receivable. Notes receivable records written. Promises from customers or other entities to pay the company a specific amount at a future date. These notes are legal instruments that provide more security than simple credit sales. Its nature is debit. It increases when a note is received and decreases when the payment is collected or the note expires. For example, a customer buys equipment worth $50,000 and signs a 90-day promissory note. The company records debit notes receivable. Credit sales. One payment is received. It records debit cash or bank credit notes receivable. This account is important because it formalizes obligations and strengthens the company's rights if legal collection is necessary. A simple case. A client without cash signs a note due in 3 months, giving the company legal backing. Notes receivable combine flexibility in sales with protection of future inflows, balancing risk with security. Importance of notes receivable. 1. Legal enforceability. Promissory notes serve as legal proof of debt. giving the business stronger legal rights in case of non-payment. 2. Improved risk management. Notes reduce the risk associated with informal or open credit by setting clear terms, deadlines, and consequences. 3. Accurate financial reporting. Interest income from notes is recognized and tracked separately, giving a more precise view of profitability and returns. 4. Flexibility. They allow for more flexible payment arrangements while still protecting future cash inflows. 5. Collateral use. In some cases, notes receivable can be used as collateral to secure financing from banks or lenders. Notes receivable combines the flexibility of extending credit with the security of a formal agreement. It strengthens companies' legal position while enabling sales and transactions that might not be possible on a purely cash basis. As a result, it plays a critical role in balancing risk, cash flow timing, and customer relationships. Proper tracking, interest recognition, and classification ensure accurate financial reporting and minimize potential losses.
1. Accounts payable suppliers. The accounts payable account represents debts the company owes to its suppliers for goods or services purchased on credit. It is one of the most common liability accounts and shows how much of the company's resources are financed by others. Its nature is credit. It increases when the business receives goods or services without paying immediately, and it decreases when the company settles its obligations. For example, if a company buys $20,000 in merchandise on 30-day terms, the entry is debit inventory and credit accounts payable. Later, when the debt is paid, it records debit accounts payable and credit. Bank. This account is critical for managing relationships with suppliers, as prompt payments can build trust and better terms. A simple case: a store buys goods today but pays in a month. In summary, accounts payable reflects the short-term debts a company must manage carefully to maintain financial stability and supplier confidence. Managing accounts payable effectively is crucial for maintaining good supplier relationships. Timely payments can build trust and may lead to better payment terms or discounts. In simple terms, a store buys goods today but pays for them in a month. This delayed payment becomes part of accounts payable, reflecting the store's short-term obligations. In summary, accounts payable tracks short-term debts and is vital for maintaining both financial stability and supplier confidence. Two. Other creditors. The other creditors account records obligations to people or entities that are not regular suppliers of goods, but who provide services or other resources. Its nature is credit, increasing when the company acquires a debt and decreasing when it pays. For instance, if a lawyer provides $5,000 in legal services on credit, the entry is debit legal expense, credit other creditors. When payment is made, it is reversed. This account is important because companies often rely on third-party services such as consultants, contractors, or professionals, and these debts need to be recorded accurately. A practical case would be hiring an IT specialist to repair company servers, with payment agreed after 15 days. In summary, other creditors demonstrates the company's obligations beyond its main suppliers, ensuring transparency and control over all outstanding debts. This account is particularly important for tracking short-term liabilities that arise from third-party services such as consultants, independent contractors, IT professionals, or other service providers. A practical scenario might involve hiring an IT specialist to repair the company's servers, with payment scheduled for 15 days later. Recording this transaction under other creditors ensures that the company maintains accurate records of all obligations, not just those owed to inventory suppliers. In summary, other creditors reflects a company's financial obligations to service providers outside its core supply chain, supporting transparency and control over its outstanding debts. 3. Notes payable. Notes payable records written promises to pay specific amounts in the future, usually with interest, and signed in the form of promissory notes. Its nature is credit. It increases when the company signs a note and decreases when the note is paid. For example, if the company borrows $50,000 from a bank and signs a 90-day note, the entry is debit bank, credit notes payable. When it pays, the reverse entry is made. Often, interest expense is added as well. This account is important because it represents more formal obligations than simple accounts payable, giving lenders legal security. A simple case: a company cannot pay a supplier immediately, so it signs a promissory note due into months. In summary, notes payable shows the company's formalized, short-term or long-term obligations and reflects reliance on external financing. This account is significant because it represents more formal and legally binding obligations than standard accounts payable. Lenders and creditors are given stronger legal assurance through promissory notes, which often include defined terms for repayment and interest. A typical example might involve a company unable to pay a supplier immediately. Instead of a regular invoice, the company issues a promissory note promising payment into months. This transaction would be recorded under notes payable rather than accounts payable. In summary, notes payable reflects the company's formalized, short-term or long-term borrowing, emphasizing its use of structured external financing and its commitment to fulfill legal obligations. 4. Taxes payable. The taxes payable account includes amounts owed to the government for obligations, such as income tax, value-added tax VAT, or payroll taxes. Its nature is credit, increasing when taxes are accrued and decreasing when payments are made. For example, if a company calculates that it owes $25,000 in VAT at the end of the month, the entry is debit VAT collected, credit taxes payable. When it pays, it debits taxes payable and credits bank. This account is crucial because failing to manage taxes properly can lead to penalties and legal consequences. A real case: a company withholds payroll taxes from employees and must remit them to the tax authority. Taxes payable ensures these amounts are tracked and remitted accurately. In short, it reflects the company's responsibility to the state and society. This account plays a vital role in financial management and compliance. Mishandling tax obligations can result in penalties, interest charges, or legal actions. Proper tracking ensures timely remittance and accurate financial reporting. A practical example is when a company withholds payroll taxes such as income tax or Social Security contributions from employees' salaries. These withheld amounts are not company funds but liabilities owed to the government. They are recorded under taxes payable until remitted. In summary, taxes payable reflects a company's legal and civic responsibility to meet its tax obligations, promoting transparency, compliance, and financial discipline. 5. Salaries payable. The salaries payable account represents wages earned by employees that have not yet been paid. Its nature is credit, increasing when payroll obligations accumulate and decreasing when payments are made. For instance, at the end of the month, employees have earned $50,000 but payday is next week. The entry is debit salary expense, credit salaries payable. When the company pays, it debits salaries payable and credits bank. This account is important because salaries are often the company's largest expense, and failing to manage it can create employee dissatisfaction. A practical example: staff complete a pay period, and the business owes them until payday. In conclusion, salaries payable ensures accurate recognition of employee obligations and reflects financial responsibility toward the workforce. This account is crucial because salaries are often among a company's largest recurring expenses, and delayed or mismanaged payments can lead to employee dissatisfaction, low morale, and even legal issues. A practical example would be a biweekly pay cycle, where staff complete their working period, but payday is scheduled for the following week. The earned but unpaid wages must be recorded under salaries payable to ensure accurate financial reporting. In conclusion, salaries payable reflects the company's financial obligations to its workforce, supporting transparency, employee trust, and responsible payroll management. Equity capital credit accounts. 1. Capital stock. The capital stock account represents the initial contributions made by owners or shareholders when forming the company. It has a credit nature, increasing when capital is invested and decreasing only when capital is withdrawn. For example, if two partners each contribute $50,000, the journal entry would be debit, bank $100,000, credit, capital stock $100,000. This account is essential because it reflects the foundation of the company's financial structure. In short, capital stock is the backbone of ownership, showing how much the owners have invested in the business. Importance of capital stock. Represents ownership. Capital stock reflects shareholders' ownership in the company. Legal foundation. It establishes the company's equity base and is legally documented in the Articles of Incorporation. Protects creditors. Capital cannot be withdrawn by shareholders casually. This protects creditors by ensuring a minimum level of company funding. Basis for dividends. Dividends are typically paid based on the number of outstanding shares, not the capital stock value itself, but it still plays a role in ownership rights. Capital withdrawals. Unlike sole proprietorships or partnerships, where owners can withdraw capital through drawings or partners' withdrawals, corporations do not allow shareholders to simply withdraw capital. Returns to shareholders are done through dividends, share buybacks, liquidation if company closes down. Any such reduction must comply with corporate laws and financial reporting standards. 2. Legal reserves. Legal reserves are mandatory amounts set aside from profits to comply with laws or company bylaws. Its nature is credit, increasing when reserves are created. For example, if a law requires 5% of annual profits to be reserved, the company records debit retained earnings, credit legal reserves. These funds cannot be distributed as dividends. This account shows stability and compliance, protecting the company and its creditors. Key characteristics. Non-distributable, cannot be used to pay dividends or bonuses. Permanent or semi-permanent, often retained for the life of the company, unless otherwise allowed by law. Equity component, appears under the equity section of the balance sheet, reinforcing the capital base. Importance in financial reporting. Enhances creditworthiness of the business. Shows prudence and compliance with legal or statutory requirements. May affect the dividend policy of the company. Purpose of legal reserves. 1. Compliance. Many countries require companies to allocate a percentage of net income to legal reserves, for example, 5% of annual profit until a maximum threshold is reached, often 10-20 of paid-in capital. 2. Creditor protection. These reserves improve the company's ability to absorb losses and protect creditor interests by preventing full profit distribution. 3. Financial stability. Demonstrates long-term planning and reinforces retained equity, adding to investor and stakeholder confidence. 3. Retained earnings. Retained earnings represent profits accumulated over time that are not distributed to shareholders but reinvested in the business. Its nature is credit, increasing with profits and decreasing with distributions. For example, a company earning $200,000 in profit may decide to keep $150,000 as retained earnings. This account is crucial for growth as it finances expansion without borrowing. Importance of retained earnings. 1. Growth funding. A primary source of internal financing, especially for expansion, R&D, and capital investments. 2. Financial health indicator. A consistently growing retained earnings balance reflects sustained profitability. 3. Dividend policy. Management decides how much profit to retain vs distribute. Aggressive growth companies retain more. 4. Loss absorption. Retained earnings can offset future losses without immediately affecting capital stock. Limitations and considerations. Negative retained earnings. Repeated losses can lead to a deficit, shown as a negative balance in equity. Dividend restrictions. In some jurisdictions, companies can't declare dividends if retained earnings are negative. Auditor attention. Large, retained earnings balances may be scrutinized to ensure they're not overstated or misused.